A pleasant day, everyone. I am actually Elisha B. Daga-ang, BSMA 2 from Econ 122 73106 2:30 to 3:30 p.m. TTHS. This is my assignment number 9, focusing on money, monetary system, and policy. So to start, the first question is, what constitutes money nowadays and its role in the economy? Money today is quite different from what it was historically. It is a system based on trust and acceptance that facilitates the exchange of goods in an economy. It allows buyers and sellers to pay less in transaction costs compared to a barter trading. Before, the first form of money were commodity money such as grain or livestock. Now, in contemporary markets, money is essentially a medium of exchange, something widely accepted for the purchase of goods and services and repayments of debt. Now, what constitutes money today? The first one is physical currency. This includes coins and banknotes issued by central banks and governments, which are used for transaction with lower level of digitalization. The second one is central bank reserve. These are deposits held by commercial banks at the central bank. They serve as the basis for interbank settlement and are crucial for maintaining liquidity and stability in the financial system. The third one is commercial bank money. It refers to the money created by commercial bank through the process of lending. The fourth one is fiat money. It's government-issued currency that isn't backed by a physical commodity like gold, but by the faith and stability of the issuing government. The value comes from people's trust that it can be used to buy things. And lastly is the digital currency. This is a relatively new type of money. Cryptocurrencies like Bitcoin are digital tokens that use cryptography for security. Knowing this, let's proceed to the role of money in the healthy economy, which was discussed before in my finance course, and it acts as first medium of exchange. As mentioned earlier, it facilitates transactions by eliminating the needs for bartering. Second is a unit of account. It provides a common unit for measuring value of goods and services, making it easier to compare prices and track economic activity. Third one is store of value. Money allows you to store your purchasing power over time. Ideally, it retains its value so you can use it later to buy things. And lastly is as means of payment. It is being used for the settlements of any exchange for the convenience of all parties. In all things that matter, money is a complex but essential part of our economic system. It shapes how we produce, consume, and invest. So knowing about the money and its role in the economy, let's proceed to the question number 2. Explain the factors and motives that affect the demand for money. The demand for money isn't just about how much cash you want to carry around. It's about the total amount of money people want to hold, considering different factors and reasons for holding onto it. There are 3 motives that affecting the demand for money. The first one is transaction motive. It is about people need money for everyday purchases. If economic activity increases with more goods and services being bought and sold, the demand for money to conduct this transaction goes up. So just think about a holiday season. The second one is a precautionary motive. We all face unexpected expenses. People hold onto some money as a buffer for emergency or unforeseen needs. Uncertainty about the future can also increase this motive for holding cash. Third one is the speculative motive. This is about using money strategically. If interest rates are low or people expect them to fall, they might prefer holding onto cash rather than investing it in assets that offer a lower return. Conversely, high interest rates might incentivize investment over holding cash. Aside from these 3 motives, the factors that affecting demand for money are first, the level of income. The demand for money tends to increase as income or GDP rises due to the increase in the total number of transactions made in an economy. The second one is interest rate. The rate of interest on loans is a key factor affecting the demand for money. Changes in interest rate can influence how many households and business are willing and able to borrow, impacting the demand for money. And the third factor is inflation. Expectation of higher inflation can reduce the speculative motivation for the desire for money, as it forecasts a greater decline in the purchasing power of money. Fourth factor is uncertainty about the future. A rise in uncertainty about the future and future opportunities can increase the demand for money. And the fifth factor is transaction cost. A rise in transaction costs to buy and sell stocks and bonds can also affect the demand for money. In summary, the demand for money is influenced by the level of income, interest rates, inflation, and uncertainty about the future. The three motives for demanding money, transaction, precautionary, and speculative, provide a framework for understanding how these factors affect the demand for money. So knowing about these factors and motives, let's proceed to the third question. What is monetary system? How does it differ from monetary policy? Initially, the monetary system encompasses the creation, circulation, and regulation of money and its various forms, including coins, banknotes, and digital currency established by government and central bank. While on the other hand, the definition or the meaning of monetary policy is a set of tools and strategies used by a nation's central bank to control the overall money supply and influence economic conditions. It involves actions taken to achieve specific macroeconomic objectives such as price stability, maximum employment, and moderate long-term interest rate. Therefore, what makes it differ to monetary policy is that the monetary system pertains to the overall structure and operation of a country's money, supply, and currency. It is a more permanent framework and facilitate transaction. So the first question is, enumerate and explain the types of monetary policy and does each type work. So the first monetary policy is expansionary monetary policy. This is a monetary policy that aims to increase the money supply in the economy by decreasing interest rate, purchasing government securities by central banks, and lowering the reserve requirements for banks. An expansionary policy lowers unemployment and stimulates business activities and consumer spending. The overall goal of the expansionary monetary policy is to fuel economic growth. However, it can also possibly lead to higher inflation. The second monetary policy is the contractionary monetary policy. The goal of a contractionary monetary policy is to decrease the money supply in the economy. It can be achieved by raising interest rate, selling government bonds, and increasing the reserve requirement for banks. The contractionary policy is utilized when the government wants to control inflation level. So knowing about this, let's proceed to the last question, which is, give examples of specific monetary policies here in the Philippines. There are three important monetary policy in the Philippines published by the Bangko Sentral ng Pilipinas. The first one is monetary aggregate targeting. This monetary policy was implemented in 1985 and second quarter of 1995. This approach was based on the assumption that there is a stable and predictable relationship between money, output, and inflation. On the assumption that the money velocity remains stable over time, changes in money supply are directly related to price changes or inflation. Moreover, the central bank controls the domestic liquidity. Thus, Bangko Sentral ng Pilipinas was able to determine the level of money supply that is needed given the desired level of inflation that is consistent with the economy's growth objective. The second monetary policy is the modified monetary aggregate targeting. This monetary policy was implemented in third quarter of 1995 to 2001. This approach placed great emphasis on price stability instead of strictly attaining set targets for monetary aggregates. The purpose of this framework is to enhance the effectiveness of monetary policy by complementing monetary aggregate targeting with some form of inflation targeting. The monetary value could be exceeded as long as inflation targets are met. And lastly, the monetary policy is Third one is inflation targeting. This monetary policy was implemented in 2002 until the present. It is the BSP's best way of conducting monetary policy to achieve its primary objective of price stability. In this approach, the BSP assesses monetary condition and forecasts inflation. The goal of inflation targeting is to focus on maintaining a low level of inflation, which is considered to be optimal and allow the country to have ample economic growth. The Bangko Sentral Pilipinas communicates through press statements, highlights of monetary board meetings, inflation report, and open letter to the president. So knowing about this three important monetary policy in the Philippines, I hope you learned something in my assignment, and thank you for listening. That's all, and bye!